Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
Today we've got three major stories for you. First up, the IMF has raised its global growth forecast, but its own chief economist is warning it's a sugar high that could make your next smartphone over 25% more expensive. Then we'll dive into a massive $85 billion merger between Union Pacific and Norfolk Southern, a deal creating a coast-to-coast railroad that unions are already vowing to fight. And finally, AI startup Anthropic is looking to raise $5 billion at a jaw-dropping $170 billion valuation, forcing its CEO to reverse his stance on taking Middle Eastern funding. The International Monetary Fund just boosted its global growth forecast, but the reason why is sending a major warning shot across the market. This isn't a story about a fundamental economic boom. The upgrade is happening because American firms went on a massive import surge, scrambling to get products into the country to beat impending higher taxes. The IMF calls this front-loading, and it warns this short-term sugar high could be setting the stage for a future economic drag. So how do massive companies even pull this off? Well, it comes down to incredibly sophisticated technology. We're talking about predictive analytics and artificial intelligence to model the impact of tariffs and optimize shipments. Major logistics firms use AI-driven systems to recalibrate delivery paths in real time, ensuring those products get to warehouses before the deadlines hit. Now, this is a high-stakes gamble, especially for sectors like semiconductors and pharmaceuticals. The average life cycle of an electronic component has plummeted from 30 years down to less than 4 years today. A computer chip stockpiled now could be obsolete before it's ever used. It's a massive financial risk. This is where the situation takes a more complex turn. The IMF's own chief economist, Pierre-Olivier Gourinchas, put it bluntly, stating, "The world economy is still hurting, and it's going to continue hurting with tariffs at that level." He warns the boost from this import rush is going to fade away. Even with the upgrade, the new growth projection of 3.1% for 2026 remains below the pre-pandemic historical average of 3.7%. So we're not back to normal yet. And there's another layer to this. The IMF's new numbers don't even include the impact of steeper tariffs that have already been announced for major sectors like cars, steel, pharmaceuticals, and computer chips. Those potential shocks are still waiting in the wings. What's really going on here is that this situation reveals a huge blind spot in how these global forecasts are made. Economic models, even the IMF's, struggle to predict outcomes when they're driven by sudden political decisions. They rely on historical data, but there's no historical model for this level of trade volatility. They are essentially trying to predict chaos, and that's why these unconfirmed tariffs are left out. So what's the bottom line for the average person? The IMF says inflation in the US will probably remain above target, because the costs of existing import taxes are expected to be passed directly through to consumers. This creates a fascinating paradox for the tech you buy every day. For decades, we've been conditioned by Moore's law to expect our electronics to get better and cheaper every year. But these tariffs on essential components like semiconductors and lithium-ion batteries could finally break that trend. Some analysts project that certain tariffs could increase the price of a new smartphone by over 25%. That long-standing consumer expectation of cheaper tech could be coming to an end. This all begs the question, are we witnessing a fragile recovery, or are we just watching the calm before a much bigger trade storm hits? Ultimately, this front-loading is a short-term tactic that reveals a much bigger, long-term strategic shift. Tech companies are using the cover of this tariff chaos to accelerate a permanent move of their supply chains away from dependency on a single country. We are seeing a massive pivot with nations like India and Vietnam emerging as the new tech manufacturing hubs. For example, US smartphone imports from India have surged, while the share from China has plummeted. This isn't just a temporary shuffle, it's a fundamental reshaping of the global manufacturing map. As a reminder, all financial markets are subject to volatility, and this report does not constitute investment advice. Market conditions can change rapidly. Speaking of the complex logistics of global trade, a massive change is brewing right here at home that could reshape the entire US freight network. For the first time in American history, a single railroad is set to connect the Atlantic to the Pacific. Two of the nation's largest railroad giants, Union Pacific and Norfolk Southern, just announced a blockbuster $85 billion merger. The deal creates a $250 billion colossus, a freight network of more than 50,000 miles of track, linking 100 ports across 43 states. Now, the significance of this goes far beyond just the sheer size. You see, merging two of these 19th century giants isn't like combining two tech companies. They have to merge their incredibly complex and separate IT and signaling systems. We're talking about something called positive train control, or PTC, which is the digital system that prevents train collisions. Both railroads have it, but they don't necessarily speak the same language. The challenge is making these systems work together seamlessly across the entire country without causing catastrophic supply chain failures. It's a massive technical hurdle. Executives are calling it a new era of efficiency, promising to shave days off cross-country shipping times. Norfolk Southern's chief even declared the deal is making history, but the track ahead is far from clear. This merger is sparking a massive conflict. While the companies promise a better railroad, at least one major union, SMARTTD, is already vowing to fight the deal with regulators. And here's where the real fight will be. The companies will argue to regulators that this isn't about crushing rail competition. Instead, they'll claim this new, more efficient giant will be better positioned to compete against the massive trucking industry. It's a classic good monopoly argument, but it's a tough sell. The situation presents a fascinating duality. On one side, you have the promise of AI-powered scheduling and automated track inspections, creating incredible efficiency. Research shows these systems are already improving on-time performance by up to 12%. On the other, the unions see the writing on the wall. The rail industry has already shed over 20,000 jobs in recent years due to automation and cost cutting, so their fears are based on a very real trend. While executives say they are confident they can handle any issues, the battle lines are being drawn. The new company, to be called Union Pacific Transcontinental Railroad, promises a seamless network that has been impossible since the first tracks were laid in the 1800s. However, if you zoom out, you'll see another layer of risk at play. Creating this seamless network also creates a massive single point of failure for the entire US supply chain. A single nationwide labor strike could become even more crippling. And what about a cyber attack? This isn't just a fantasy. European rail networks have recently faced thousands of cyber attacks targeting their signaling systems. Our own government has warned that some US rail communications aren't even encrypted, making them vulnerable. This merger concentrates that risk on a scale we've never seen before. The deal offers Norfolk Southern investors a value about 25% higher than the recent share price. The question now is, as this new giant prepares to dominate American freight, who will ultimately pay the price for making history? We were just talking about AI transforming legacy industries. Now, let's shift our focus to the heart of the AI gold rush itself, where the numbers are getting almost unbelievable. AI startup Anthropic is in talks to raise up to $5 billion at a valuation of $170 billion. To put that in perspective, just months ago, in March, Anthropic was valued at $61.5 billion. That's nearly a 3 times jump in valuation in the blink of an eye. So what's driving a valuation like that? It all comes down to explosive growth metrics. Research shows Anthropic's annual recurring revenue has skyrocketed to around $4 billion. That's a 10-fold increase in just 1 year, fueled by massive strategic partnerships with giants like Amazon, who have poured $8 billion into the company to make them their primary cloud and training partner. The new funding round, led by Iconic Capital, signals an insatiable investor appetite for a piece of the AI pie. But the real story isn't just the price tag, it's where the money is coming from and the high-stakes reversal it's forcing. A leaked memo reveals Anthropic's CEO Dario Amodei is now changing his tune on taking money from the Middle East, an idea he previously rejected over national security concerns. He had warned about granting soft power to authoritarian regimes. His justification now, he wrote, it's become, quote, substantially harder to stay on the frontier of AI development without tapping into Gulf sovereign wealth. And staying on the frontier has, believe it or not, become one of the most expensive races in human history. The cost to train a single top-tier AI model is doubling roughly every 10 months. For example, training a model like GPT-4 required over $100 million in computing resources alone and used as much electricity as 4,500 American homes for an entire year. Projections show that by 2027, a single training run could cost over $1 billion. the price of admission to this club is astronomical. This isn't happening in a vacuum. Anthropic's main rival, OpenAI, is valued at a colossal $300 billion and is already working with Emirati firm G42 to build a massive data center in Abu Dhabi. The pressure to compete is immense. Interestingly enough, that leaked memo from Anthropic CEO spells out the cold, hard math. He wrote, and I'm quoting directly from his internal memo, "There is a truly giant amount of capital in the Middle East, easily $100 billion or more. If we want to stay on the frontier, we gain a very large benefit from having access to this capital." He even acknowledged the dilemma, adding, "This is a real downside and I'm not thrilled about it." The move highlights a dramatic power shift in global tech, where the immense capital from sovereign wealth funds is becoming too powerful for even the most cautious founders to ignore. What really brought this to a head is the realization that this isn't just about one company. It signals a massive consolidation in the AI industry. The sheer cost to compete is creating a world where only a handful of gigantic, well-funded players like OpenAI and Anthropic can survive. Experts are already warning this could create a duopoly, potentially stifling the very innovation and competition that got us here in the first place. This leaves one massive question hanging over Silicon Valley. In the multi-trillion-dollar race for AI supremacy, are national security warnings becoming the price of admission? As the capital flows, the line between innovation and influence is getting blurrier by the day.
That's it for today on Valuation Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.